November 14th, 2023. We got a couple different measure moves today. You can see we got this trading range going from essentially bar 36 to bar 50, 50, 57 more or less, or you could say the top of the trading range was here, so it went to there. But regardless, we ended up getting a measured move up of that trading range. You can see from here to here, and that's where the high of the day was, basically on 70. There's an 82.5% chance that we break out of the 36 bar range. There's a 90% chance we break out of the 18 bar range, but there's an 82.5% chance we break out of the 36 bar range. So I think that's what this whole rally was trying to do, was break out of the 36 bar range. And we also got a two-legged move up on the open. You can see from bar 1 to bar 7, we got a bull micro channel. And it's unusual to get a micro channel on the open, especially that's this strong. So we ended up getting a leg 1, pull back, and then a leg 2. And that's where the high of the day was, basically, within one tick. I think I missed by a tick on one of these. Yeah, I have my missed. Hold on. Let me redo it. I believe it was exact. Yeah, it was exact. So it was 1, pull back 2. So we ended up essentially getting 2 legs up in the channel phase. And you can think of this whole gap as a spike. So it was a spike and then a channel up. And then we formed a trading range. So that's the whole market cycle, right? Is spike, channel, trading range, which you can generally expect. I also want to mention that yesterday I said in my review at the end of the day, I thought that we were probably going to gap down tomorrow. I thought it was more likely we went down tomorrow. And I think this just goes to show that, you can only ever be 60 to 70% certain that anything's going to happen in the stock market, because there needs to be a trader willing to take the other side of your equation. Anytime you take a trade, there has to be a trader taking the other side, which means no matter how sure you are of something, there's always at least a 40% chance that the exact opposite of what you think is going to happen happens. And that proved true today. I did not think that we were going to get gap up. It's pretty unlikely, to be honest, that after the context of the past couple of days that we get a large gap up like we did today. But it can still happen. So you have to be prepared to always trade anything. We had a big bull bar on bar 1, but it had a big tail on the top and a big tail on the bottom. So kind of disappointing for the bulls. But it shows that the gap was accepted. If the gap was getting rejected, we would have gotten a big bear bar closing near its low, and bears would have been selling and trying to get a big swing down. And that really just didn't happen. We ended up getting an inside bar on bar 2 as well. A lot of times, not all the time, but you definitely a couple times a month get an inside bar on the second bar of the day. And sometimes that inside bar ends up being the opening swing. A couple different examples. We have an inside bar at bar 6, opening swing. Bar 3, we had an II pattern, opening swing. Here we had an inside bar on bar 2, opening swing. And they usually end up, a lot of times they'll end up being the low or the high of the day. Here was the high of the day. So a lot of times when you get an inside bar early, it ends up being the low or the high of the day. So, these kind of trades, like buying above 2 here or buying above 3 here, selling below 2 here, or today, buying above 2, it's a risky thing to do, but it makes sense because every once in a while you're going to get something like this where you get a big trend and you end up making 20, 30 points. It's okay to wait for higher probability, but it's definitely okay to buy above 2 as a swing trade. It's just you have to understand if you're going to buy above 2, it's a low probability swing trade. So it's low probability that you're going to get a big trend, but occasionally you will, and that should cancel out your losers and you should make money. Bar 3, more follow through. Once you get bar 3, I think it's okay to buy. I think it's pretty clearly always in long from the gap, and now you have a good bar of follow through on bar 3. So I think it's reasonable to buy above 3, assuming that we're going to continue to rally. Bar 4 is a bit disappointing for the bulls. It's a bull bar, but a big tail on the top, and with all these tails on the bottoms and with the big tails on the top and a bottom of 1, it tells me we might be more sideways rather than up. Bar 5, a bull bar, but not quite, again, able to close near its high. A lot of disappointment for the bulls early. They only have one really good close, and that's bar 3. And bar 3 wasn't even as big as you'd like it to be. But you have to note that there's a breakout point above 1, and we haven't closed that breakout point yet. So we have an open gap early in the day. Bar 5, bull bar, like I just mentioned. Bar 6, another bull bar. Bar 7, another bull bar. So we have a strong bull micro channel. it's strong enough that you know that the first reversal down is probably going to fail. So if you're wondering why are bulls buying all the way up here if we're probably going to pull back soon, it's because the bulls know that either they're going to be able to buy and we're going to continue up, or they're going to be able to buy and scale in lower, and then we're going to go sideways to up. So that's exactly what's happening on 8. We start to get a pullback because this is relatively overdone. But as we get the pullback, bulls are buying below because they know that it's most likely that we're going to get a second leg up. Bar 8 is a deeper pullback than you want if you're hoping we're going to get a big bull trend day today. So bar 8 is a little bit disappointing for the bulls. But bar 9 is a small inside bull bar closing near its high. If you're an always in bull and you bought for any reason, I thought if you're an always in bull, you could have bought above 3 and just added on bull closes. I don't think you should get stopped out below 7, but some bulls will be trailing their stop below each bar, thinking that the pullback might be somewhat deep. And if you do get stopped out and then you get another bull bar on 9, those bulls are going to buy again. And those bulls buying again, it's what's causing 10, 11, and 12. I thought buying above 9 was a relatively low probability trade, and one of the reasons for that was the close of bar 7. If you bought the close of 7 and you saw 8, how do you feel? You're really disappointed. You wanted us to continue to rally. So what the bulls who bought 7 are probably going to do is scale and lower and start to sell out as we get back up to their break-even price. That's kind of what was happening on 10 as we got back towards the close of 7. As those traders were starting to sell out around break-even. And so you have to be wondering if you're on the close of 10, if you're going to end up finding sellers here rather than buyers. Luckily, we ended up finding buyers on 10. Luckily for the bulls, anyways, they ended up finding buyers around this area rather than sellers, and we got more follow through with the bulls on 11 and 12. Now, think about how much money has every type of trader made today. There are limit order bulls, stop order bulls, limit order bears, stop order bears. Stop order bulls could have bought above any bar so far today, and they're making money. Limit order bulls have only had one chance to buy, which was below 7, and they're making money. Stop order bulls have not made any. They've just lost money today, and they've only even had one chance to get in, selling below 7, and that doesn't make any sense to do. But they've only really had one chance to get in. And limit order bears have just gotten crushed today, and they haven't made any money yet. So it's clearly bullish. Clearly, bulls are the only ones making money. So we're probably going at least a little bit higher. We have more follow through on 12 and 13, and then a disappointing bar on 14. When you get 14, it doesn't, it's still okay to be long. Obviously, we're probably going to continue sideways. 15, a bull bar, but not a strong close. Anyone who bought the close of 14 or 13 kind of disappointed at 14, and some of those bulls were selling out during 15, causing this tail on top. You can see bulls were selling out as we went to a new high on 16, and some bears will start to scale on the shorts. But again, any bears who are selling, maybe even above 11, are still trapped in. So we have a lot of trapped bears early in the day, which could lead to a bull trend day that lasts all day. It's not all that likely because of, the pullback on 8 was deeper than you want it to be. Everything is relatively overdone. So it's not as likely that we're going to get a big bull trend all day, but it's still possible. 17 and 18 are interesting. We get essentially probably buyers below 16 during 17. So basically a big bar with a big tail on it. And then 18 trades down and we find buyers around the 15 low. And any bulls who had their stop below the 15 low, we're not able to, we're not run, right? We get a bull bar on 19. It's okay for, any always in bulls who exit for any reason can probably buy again above 19 for a swing up. It's a swing trade. If you buy above 19, it's probably not going to work out, but it might sometimes. I think it's kind of similar to buying above 9. It's low probability, but occasionally it will go. And again, here, if you bought above 19, you're going to end up exiting below 22. But if you bought above 9, you'll also end up exiting below 22. So you can see you make good money here, and you end up break even on the buy above 19. Something else that's interesting is on the Emini, every one tick on the Emini is generally equivalent to 3 ticks on the SPY. So every 3 cents on the SPY is 1 tick on the Emini. And so I don't know. I like to look at this. This is the way I like to think of this anyways. The 18 low went 2 ticks below the 15 low, which means it was as close as it could have possibly been to going 1 tick below the 15 low without getting there. Or sorry, it's equivalent. Every 1 tick on the Emini is equivalent to 2.5 ticks on the SPY, but you can't have a half a tick on the SPY. It's either a full cent or it's not. So basically, when it trades 2 cents below 15, it was as close as it could have possibly been. It's 2/3 of an E-mini tick to going below 15 on the E-mini, but it wasn't quite able to get there. Versus if it just tested the 15 low and then bounced, it would have been, as far away from going a full E-mini tick below. So it's a little subtle thing that can help you tell, if you want to look at it. You don't need to, but I just think it's interesting to look at, how close were bears to running stops that were below 15, right? In this case, on 18, they were really close to running those stops, but they weren't quite able to on the E-mini, because bulls will have their stops 3 ticks below. I think I was on, like I said, I thought 19 was a reasonable buy. Something else at buying above 19 you have to keep in mind is there's a 90% chance you're going to break out of the 18 bar range. I would say by bar 3, there's a 30 to 40% chance we've seen the low of the day. I think at this, maybe there's a 20% chance, maybe 25% chance this is the low of the day. And by the time you get all the way up here, it becomes, 30, 40, 50, etc. And so at this point, it's probably like a 70 or probably an 80 to 90% chance we've seen the low of the day, and probably closer to 90 than 80. And so it's most likely that we're at least going above here. So the bulls buying above 19, no, we're probably at least going to this high. And it doesn't trigger on 20, and then we get a big bull surprise on 21. But the bears who sold above 20 are probably going to make money. This is a sideways 3-push pullback, 1, pullback 2, pullback 3. But it's probably going to lead to sideways trading. And you can see, the main piece of their premise, other than the fact this was a bull trend, was that we might get a breakout of the 18 bar range. And by the time you get 21, that piece of that premise goes away. Additionally, look at all of these bars in this bull trend. What's the best looking bar? From 1 to 21, what is the strongest looking bar? Probably 21. 21 is the best looking bar in this entire trend. 7 is bigger, but has a bigger tail on the top. So 21 is the strongest looking bull bar in this entire bull trend, and you're 20 bars into the trend. Generally, when you get that, this gap between the 16 high and the 21 high is an exhaustion gap rather than a measuring gap. So it's probably going to close within a few bars. And so that when you get a strong bear close on 22, always in bulls are going to exit below 22. If always in bulls are going to exit below 22, it's probably a reasonable swing sell for the bears. As you can see, we ended up getting a move down. But usually, with how strong this is, if you're selling below 22, you're probably going to get bad follow through, and it's going to be really hard to hold for the whole swing. So as expected, bad follow through on 23 for the bears. If you're a bear who sold below 23, think about how you're feeling when you see, or sold below 22, think about how you're feeling when you see 23. So a lot of those traders are exiting around break even during 24, and that's why the tail on 24 goes to around the entry price and get buying there. 25, disappointment for the bulls. Probably not that many buyers above 24. Bulls might buy above 24 because if you're trading from an always in perspective, you're probably going to want to buy bull closes in a potential bull trend. And you could argue that 22 was just a bear trap and not actually an always in flip. And so that's a potential reason why there could be buyers above 24. However, bears sold to close at 24, trying not to let it trigger because they know a lot of bears will be exiting above 24 and bulls will be buying. And it doesn't trigger, and that's why you get 25. 25, we go down, and then we pull back, and then we get 26. But what does that look like? 1, pullback, 2. So 26 might just be a second leg trap. And with 22, it could be a nested second leg trap or, essentially a wedge pullback. 27, it's a bull bar closing near its high, and it's a high too, but I think the premise of always in long is a lot less valid than it was, 5 bars ago, because you're getting decent bear closes. So I think it's better to wait rather than to buy above 27. You're kind of just buying the top of a tight trading range, and the upside is very, very limited at this point, most likely. So that's one of the reasons why you get disappointment on 28. I don't know if you guys were watching, but 28 was kind of sitting around its entry price for the first couple minutes. And then it quickly, all basically within 5 seconds, traded down to around here. It was sitting around here and then just collapsed down to here. And the reason for that is some bulls took the buy above 27, but they were keeping it on a relatively short leash. They knew that, we probably weren't going to race up. And when we start to stall around their entry price, those bulls just flattened at the market and exited around break even, knowing that the probability was now even lower that we were going to get a swing up. And that's what caused 28. Follow through the bears on 29 and 30. I thought 30 was an okay swing sell. There was a low probability that we were just going to get a big collapse and trade down, below the one low essentially. Sometimes there was a day a little while ago where we got something similar to this, where it was a little bit better context, but it was something similar where it was actually a strong bear trend, and then we went pretty sideways and got a failed breakout below a wedge, and then a reversal up, and where it was one of those situations where you're hoping it's going to pull back and retest, but it never did. And bears were hoping that was what was going to happen today. So some bears will take the sell below 30. You get bad follow through on 31, which happens sometimes, but you get a big bear bar on 32. And so bears are hoping that we're going to continue down. But you again get bad follow through on 33. But notice that the bulls who bought below 31 were not let out at break even during 34. So 34 is a low one sell with an open gap. 35 does something extremely important. It doesn't close below the 32 low. So think about what this is, right? This is essentially, a wedge, and it's an attempt at a couple legs down and a wedge. And essentially what the bears are trying to get is a breakout below the wedge. And if they get a strong close below 32, I think their premise is pretty valid, and we might end up getting a swing down. However, what ended up happening was we got a failed breakout below that 32 low, and the bears are, if you sold below 34, you were hoping we were going to get a strong close down here. And they're disappointed they don't get it on 35. So they're buying back their shorts at the market. And that's what's causing 36. Is disappointed bears. Bears were hoping we were going to break up below here, and we don't get it. So they're buying back their shorts at the market, causing 36. And, any bears who are holding through 36, disappointed 36, keep buying back their shorts on 37. So 1 pullback, 2, 37. And there's a tail on 37 as well. So it could be 1 pullback, 2 pullback, 3, and the strongest push up usually ends up being the third push. So 38 could be a third push up for the bulls. However, this is strong enough to get its own second leg. Although this is strong enough for a second leg, this is also strong enough for a second leg. So it's not as valid to think that we're going to continue straight down, especially with how strong this is. So that's one of the reasons why we end up finding buyers down here on 39. Is I don't think the bear case is as valid. Bears are hoping 39 is going to close on its low, but even if it does, this is probably too strong to go against. 40 is the bull bar closing near its high, but not all that strong. You got to note that the 27 low at this point, bulls who bought below 27 are probably going to make money, and you can see that's exactly what 49 was testing, was that low. But my overall point being, some bulls might try to buy above 40 to get back to that 27 low, but it never triggers on 41. Bears are selling the close, trying to keep it from triggering. And additionally, some always in both bears will hold with their stop above the 31 low, since that was essentially, the last pullback. So they'll hold with a stop above the 31 high, and they're hoping that we're not going to break above it. And when you get 40 is essentially testing that 31 high, and bears are aggressively selling the close, hoping that it's not going to trigger. And when it doesn't end up triggering, so they're selling the close, hoping we get a strong bear close on 41, and it ends up getting bought up. And that's, essentially what happens here, and it's disappointing. I'm stumbling over my words. They're selling the close of 40, hoping they're going to get a big bear close because they have very low risk, right? They're 2 ticks away from getting stopped out. So they're selling this close, hoping we're going to get a big bear close, and we don't end up getting it. They're disappointed in the close of 41, so they buy back shorts, causing 42, 43. However, it's a 3 push pullback, so not too surprising that we end up getting bad follow through on 43 for the bulls. But some bulls will be buying above 43, hoping we're going to get follow through to the 22nd low. But it's generally better not to buy a third push in a bull trend, third push in a trading range, because a lot of times you're going to get follow through like you do on 44, 45. 44, it's a wedge pullback. Bears are selling, hoping we're going to get a second leg down. And you get good follow through on 45. But 45 is not quite big enough. I think you wanted to close, somewhere probably below the 41 low, because it's the third leg. So this is the third leg. And if you get a strong, it might just be a test of the low of the third leg. This 45 might be. But if you get a strong close below the low of 41, maybe it's a breakout of the third leg. 46, it's bad follow through for the bears who sold below 45. And then 47, if you sold below 45, disappointed 46, a lot of those bears will be buying back shorts, causing 47. And anyone who was still holding on to shorts will exit above the inside bar, causing 48. And then 49 gets to the 27 low and runs stops above the 46 or the 44 high. 50, not a very strong buy. It's most likely just another leg up. And there's not as many magnets above for the bulls, so it's not that valid. Over the past couple of days, I've been mentioning I thought we were going to have a sell-off at some point, and that still holds true. So I was thinking that we might start to get a sell-off here when we got 51. It was a disappointing close. I wanted a stronger close below the moving average, and we didn't get it. And then when we got the reversal up on 52, bears were hoping to sell below 51, but it doesn't close strong enough, so they're disappointed. So they're exiting, causing 52. But 52 is a high one at what's probably the top of the trading range. So it's not surprising it doesn't get any follow through on 53. 53 is a double top, so it's a wedge double top, and it's a lower high. So I think 53 is a reasonable sell to look to start to get a big sell-off. And you get good follow through on 54, bears continue to sell. Good follow through on 55, bears continue to sell. And then we reach the low of the prior leg, right? So we reach this low and an important breakout point, and there's a big failure on 56. When there's a big failure on 56, a lot of bears are disappointed. They were thinking that we were going to get big follow through on 56, and we were going to get basically a collapse down to this low. Because that was more or less the next magnet. It was probably the too high. So this was a really important breakout point, and the bears ended up getting a big failure. Additionally, the trading range might have started at bar 8, right? When we got this big bear bar. You can see we've essentially stayed within a trading range we bounced around that bar 8 low, essentially the start of this bull second leg. And we bounced again around that same low. So you have to be thinking that this might just be the bottom of a trading range. And then when you get 57, it's a micro double bottom. So a lot of the bears are really disappointed at this point, and they'll be exiting above 57. And that's causing 58 and 59. And those bears exiting is causing essentially 58 and 59. If you're a bear, you don't necessarily have to exit above 57. You're kind of playing with fire if you don't, but you don't necessarily have to. But you probably have to exit above 58, and you 100% have to exit above 59 because it's 3 straight bull bars. And bears exiting is what's causing this on 60, this move up. And bears are giving up, and that's what's causing this rally. And bears start to realize we're probably going to break out of the 36 bar range to the upside. Bulls realize it as well, and so bulls start buying. And if you notice, what is this? Think about the market cycle, right? What are we getting here? We get a breakout and then a channel, but then another breakout. So how often does a breakout of a bull channel succeed? Not very often. Additionally, so this is the breakout, this is the bull channel. These are all reasonable buy the close bars, but we get a doji bar in 67. And when you get a doji bar in a buy the close rally, usually the rally is going to end within 3 bars, but you know that we probably need to get to this high because we're so close to it. And like I said, 80%, 82% chance we break out of the 36 bar range. So traders know that the rally is probably going to end soon, but we're also probably getting here. But if it's breakout channel, then usually trading range follows, not another breakout. When you get a breakout of a bull channel, 75% chance it's going to fail within 3 bars. And so when you get those 3 bars up and then you've reached the magnet, it starts to fail on 70 on 71. And some bulls will exit below 71. And you can see the bulls who bought below 70 were hoping that we were going to get, basically something like this where we trade down and then trade outside up. And we get disappointment on 71 and they try to scale in. And the low of this is exactly at the high of this. So most of them weren't able to make money and they're starting to exit on 73. And we essentially get 3 pushes down and a wedge pullback to 75, but we end up getting a breakout below the wedge, 76, 77, and confirms that we're in fact in a trading range here. So I think we were in a trading range essentially since bar 8. For stop order trades, I thought, 2 was probably okay. 3 was okay. These are probably all buy the close bars. I thought 9 was okay. If you're an aggressive bear, 22 is okay, but you have to be willing to sit through all of this. 30 was probably fine. 53 was probably fine. 57, and these are all okay by the close bars. But probably have to get up below 70, I think, for always in. Essentially always in. I thought buy above 3, bulls exit below 22, bears can sell. Bears probably exit, somewhere up here at the latest. And, it's not really a clear spot for bulls to buy. And then bears probably sell again below 53. Exit above 57, bulls can buy above 57 or any of these bars, and they exit below 71, and maybe bears can sell. On the daily chart, we're getting, a huge, basically climactic breakout to the upside. Um, again, I've been saying it, but I'd be pretty surprised if we continue to rally. I do think this gap is probably going to end up closing over the next couple of weeks. I'd be surprised if we just keep going up. It's extremely parabolic and overdone. It's pretty rare. I mean, you don't usually just look at the chart. I mean, how often do you really get a rally that's this steep? We've gone from this low. We've gone up in 11 days. We've gone up, 380 points. That's extremely rare. So I think more than likely we're going to end up getting a pullback pretty soon. And on the weekly chart, we're getting good follow through for the bulls, but it's early in the bar. So we'll see if this lasts or if this is just a vacuum test of this high, bulls end up scalping out.